Tom Boley, Chief Market Strategist here at EarningsBeats. Hey, good morning, everybody, and welcome to this Tuesday, May 7th, 2024 edition of Trading Places Live at EarningsBeats.com. I'm Tom Boley, Chief Market Strategist here at EarningsBeats, and I'll be your host for the next, 25, 30 minutes or so. I kind of got into a pattern of finishing before the market opened recently, so I'm going to see if I can keep that going today. But it's really a pleasure to be with you all here today. Good thing here locally for me is we've got the Wells Fargo Championship PGA Tour in town this weekend. So I'll be heading out there. Of course, most of you know I'm a big golf fan, and really enjoy getting out there and watching the pros do it the way it's supposed to be done. So that'll be fun for us this week here in Charlotte, or near the Charlotte area. Anyhow, do have a big event today. I wanted to let you know, if you're not already aware, we do have a big event coming up on or at 4:30 later this afternoon. I like to do these Mythbusters events. There's a lot of stuff talked about in the media, and I love to poke holes in it. I mean, a lot of these things that are talked about, a lot of folks, a lot of analysts and so forth, they do very little research of their own. They just pick up something that sounds, kind of cute, and they run with it like it's their own. And you probably know by now, or maybe you know by now, but I'm talking about the don't go away in May. Most people say go away in May. We say don't go away in May. And so there's a little myth busting that needs to be done there. So we're going to be doing it at 4:30 this evening for our members at EarningsBeats. If you're not a member at EarningsBeats, remember you can go over to EarningsBeats.com. I'll show you how to do it just a little bit later, how you can go through and find our landing page, take a look at some of the information I'll be talking about, and then register for the event. So we'll get into all that in just a couple of minutes. But first, let's go ahead and see what happened, the action on Monday. So we had the Dow Jones Industrial Average rise 176 points, S&P 500 up 53, Nasdaq up 203. Mid caps rose 41 points. The IWM was up $2.61, and the transports jumped 32 points. So what does this mean on a relative basis? Well, mid caps led yesterday, rising 1.4%. Then we had the small caps up 1.29%, and then the Nasdaq. So small caps, mid caps still maybe finally getting their due. Taking a little bit closer look at the action on these charts, though, you can see the Dow Jones finishing and closing above the 50-day moving average. S&P 500 finishing and closing above the 50-day moving average. Nasdaq, same thing. Mid cap, same thing. Small caps. Transport's the only one lagging. I tell you, this one still just looks weak on a relative basis. I mean, even I'm looking at it, I'm trying to come up with something bullish to say about it. And yes, it's back up above the 20-day moving average. That's about all I can get out of this chart. I mean, if you look at the three key bottoms, this triple bottom at about 15.4, that's where we're trying to get through now. This is the third time. Yesterday was the third different day we've gone through 15.4 and just not able to clearly take this level out. And when you look at what all the other areas of the market are doing, there's still something going on in the transports, which, again, it's one signal. And I have a lot of signals that I look for, but this is one that remains somewhat bearish. I'd like to see it clear not only the 15.5 level, where it's been going up intraday and failing at, but also let's get back through the 50-day like the other areas of the major areas of the market. So transport still a little bit light. I just wanted to kind of point that out. We move on to the sectors. Top three groups were among our 5 top aggressive sectors. When I start talking about aggressive sectors and where I want to see leadership from, it starts with technology, consumer discretionary, communication services, financials, and industrials. Those are the 5 groups. Look at the 3 leaders yesterday. As we go through the 50-day moving average, you couldn't ask for much better leadership. We had communication services jumping 1.36%, financials 1.28%, technology 1.18%. And if we move over to some of the top leading industry groups, Airlines, part of that transportation area, jumping almost 4% and breaking out again. Now, personally, for me, I'd rather see railroads or truckers breaking out rather than airlines. But hey, this is part of the transportation group, so we'll take what we can get. Heavy construction jumping more than 3% in the industrial sector. Check this out, breaking out. This is a pretty key area of the market to be breaking out. It's been a leader. It's now seeing renewed leadership as it moves to a new 2024 high. And how about semiconductors breaking that downtrend line that we've been talking about, moving through the moving averages? Could the volume have been a little bit stronger on semiconductors? Yes, that's for sure. But a breakout is a breakout. We'd like to see a little bit more volume accompanying it. So if I got to, maybe, keep it real, that's what I would say. A big volume breakout would have been huge. Average to maybe even less than average volume on the breakout. We'll see. At least getting back through the moving averages, though, is telling us that we are much more likely in a period of consolidation than we are in a downtrend. Normally, when you are downtrending, you set a low, you bounce, you hit that 20-day moving average, and you go to a new low. That's how most downtrends get started. This one, we moved back up, kind of got a little bit above the 20 on the semiconductors there, and then we went back down below. It looked like we were rolling over, and then right back up again. If we look at the major indices, same thing. You can see the S&P 500 right here, moving up, getting just above the 20, couldn't get through the 50, rolled back over. It looked like, okay, here we go. Got another low coming up, or at least testing the prior lows. Didn't happen. So now what we've got instead is a bounce, a move back to put in a higher low, and now we've got a higher high. So this is more indicative of what a short-term uptrend looks like, not downtrend. So I think we are moving into a different phase of this period of consolidation. Maybe we're even moving into the next secular bull market advance. We don't know that yet until we take out this previous high. But what I can say is that things look a lot brighter above the 50-day moving average and above the 20-day moving average than it does below. We love to see that price action moving above. So really good action, I thought, in the market yesterday to confirm great leadership. Areas that were leading yesterday are areas that we want to lead back into another secular bull market advance. So really good action there. 10-year Treasury yield. Here's the latest. And if you look, we are right now down another 4.5 basis points, back to 4.44%, below the 20, heading back to what I thought would be support somewhere in the 430 to 440 area. I still think we're going to go down and test this area. Whether or not we hold on for a little bit and move back up, or whether we go right through, I think a lot of that will depend on the inflation reports that will be coming up. And I believe, I did not look that up yet, I think they are out next week. But let me see. That would be the April CPI report. And that is out on May 15th. So today is May 7th. Tomorrow's May 8th. So it'll be next Wednesday. We'll get that CPI report out. And I think that's going to have a big bearing on which way the 10-year Treasury yield goes, and likely which way small caps go. Because if you look at this chart on what we've seen with the 10-year Treasury yield now rolling back over, and we go back and we look at that IWM was going down, and now it's turning back up. It's back on this inverse correlation with the 10-year Treasury yield that we've kind of grown accustomed to over the last few years. And, so rates keep coming back down, and especially if that CPI report is at or below expectations, my gut is that we're going to see this strength in the market continue. So that's going to be a big report coming up next week, and you're going to want to keep an eye on that. Let's see, the Nasdaq, actually all these charts, I mean, we've been going over them. It's nice to see them back up above the moving averages. That would be the first takeaway. Second takeaway is I really want to see the PPO move back into positive territory. Right now, we still have selling momentum. Anytime the PPO is below 0, you have selling momentum. Now, what this is telling us is that it's slowing selling momentum. And if we cross the center line, it will start to turn into bullish momentum back to the upside. So that would be the next thing I'd be looking for is, can we get those PPIs, or excuse me, those PPOs? Too many PPI, PPO. We need a PPA. Anyway, if we can get those PPOs back through the center line, I think that would really start to show much, much more bullish momentum, which would in turn give us much better feeling about the next leg of the secular bull market. So still got a little bit of work to do, but what we've seen so far is very encouraging. Also, what I'm looking for, those AD lines, we're starting to see them turn back up again. I really want those to go back to new highs. So if the prices keep moving up, we want to finish strong. We want to be, seeing solid afternoon action. That is what drives the AD line higher. And it also is just, for me, good common sense. I want to see buying in the afternoon. That's what we saw yesterday. We closed right on the high, and that's what took the AD line up yesterday. A few more of those days, and we'll be right back to the highs, which will be encouraging. By the way, we're only about 1.5% away from setting a new all-time high on the S&P 500. So that 4 or 5, maybe even 6% correction or pullback that we saw, a lot of it's in the rearview mirror already as the market rebounds. Don't give up on a secular bull market. I say that all the time. Too many people, every time you turn lower, oh my gosh, here comes the bear market. Doesn't work that way. Anyway, Nasdaq 100. Same thing, moving back up above the moving averages, watching that PPO. Nice move back up on the AD line, but we got some work to do still. Not completely out of the woods, but certainly looking a lot better. In addition to that transport group that I told you was still, acting somewhat bearish. Historically, this is not a good period of May or throughout the year. The early part of May to the latter part of May, from the 5th at the close to the 25th at the close. I think it's the 5th to the 25th, close to close. That is the obviously and clearly most bearish period of May, and one of the more bearish periods throughout the year. Not horrible. It's not like that October 22nd to 27th period, or the September, was that the September 20th or 19th to the 26th period? Maybe it's 17th to the 26th. And then July 17th to the 24th. Those are weeks and periods that kind of stand on their own as being the worst. But this, for a 3-week period, is not very good historically. And so it'll be interesting to see whether or not we can make the breakout during a period of historical weakness, or maybe we just consolidate. Maybe we test the high, come back down and consolidate for a little bit, and maybe it's later in May before we actually get the breakout, or maybe into June. But the historical bullishness will pick up again. I'll be talking about a lot of this at 4:30 later today. IWM, you can see breaking back up again. This is definitely an index, in my opinion, that will benefit from the lowering of interest rates down the road. A lot of small caps borrow to fuel their growth. You'd think maybe some of the bigger companies, have to borrow to fuel their growth and all, but you get the companies like Apple and Amazon and Google. I mean, these companies are cash cows. They don't need to borrow. They're really not, other than the impact that interest rates have on the economy, they're really not impacted by rate hikes. And so you've got more of the smaller to mid-sized companies that I think are hurt, especially in an economy that has been favoring the large companies. Personally, I think that there's a lot of competitive advantages, maybe unfair competitive advantages from some of these big companies. I would not be surprised, and I don't think it's going to be that far down the road if we see breakups, kind of like the Bell companies back in the 80s. I just think that the competition is not really fair when you're trying to compete against Microsoft and Amazon and Apple, because they have their tentacles in so many different areas, and then they package things together. Especially Microsoft's a big company for packaging and bundling. And you've got companies that offer things that compete against parts of their package, but they can't compete because Microsoft lumps it in as part of a bigger package. Anyway, I could go on and on about that, but I would not be surprised. I think we're within a few years of some serious discussions about breaking up some of these large tech names. But that's something else. That's just my opinion, by the way. Take it for what it's worth. But anyway, IWM breaking back out again. Lower interest rates would really continue to help this group. So keep an eye on the 10-year Treasury yield. Transports, as I went over earlier, not really impressed with what's going on here. I mean, I'm more impressed than I was 3 or 4 days ago. I mean, we have bounced back. We did get back through 15.2, which was nice. We did get back up above the 20-day moving average, which is nice. So we've done a couple of things to repair the chart. But as I've shown you the other major indices, I think it's pretty clear that transportation is lagging in a pretty big way. And that's an indication, a barometer, if you will, of our economy, the strength of our economy, or what we're expecting in terms of the strength of our economy. It may be a signal to the Fed that be careful about how long you leave these rates up here, because transportation and other areas like small caps still not quite showing that the domestic economy is as strong as maybe we want it to be, or maybe we want it to be down the road. Moving on, moving over to EarningsBeats.com. I mentioned anybody who's new. If you go over to EarningsBeats.com, you will see right here in the middle, Mythbusters event. Don't go away in May. So everybody likes to talk about go away in May. I'll take the opposite side any day. I love to debate Wall Street. So bring it on. We're going to talk about this at 4:30. Now, the main premise, and I'll just give you this one little snippet. I don't have time to talk about what we're going to talk about throughout the entire event. Just click on the link. It'll tell you what we're going to be discussing, some of what we'll be discussing. But I will tell you this. The basic premise of go away in May is that the period from November to April is a much better period to be invested in the S&P 500 than the period from May through October. And that part is not a myth. I mean, I've got the numbers to back that up. That's a very, very strong, it's not a myth. I mean, that's a strong fact, if you will. I don't know the exact numbers right off my head, but the annualized return from November to April is 14% and change, going back to 1950. So, I mean, we're talking about, 14% annualized return for those 6 months. You want to be in the stock market from November to April. We just saw it. I mean, yeah, we had a little bit of a rough April, but we were up 25% from November through March, I guess. And then we gave back maybe 4 or 5% in April. It was still an extremely strong period of time. You want to be in. That's what history has taught us. Move into May, and the annual returns, the average annual returns are like 3.75. So not exactly 14%, right? So clearly that part of the myth isn't a myth. That's a fact. But to just make a blanket statement is wrong. And that's where I will be talking about some of the things you need to keep in mind from May to October in various areas of the market. But anyway, I'll save the thunder for 4:30. You don't want to miss it. Make sure you click that link and are registered for the event. For those of you who maybe are brand new and maybe aren't interested in that type of an event just yet, but you want to learn more about technical analysis and about the way I approach the market, the way we approach the market at EarningsBeats, sign up for the EarningsBeats Digest. It's a 3 times a week newsletter. It is completely free, no credit card. You can unsubscribe at any time. It's simply one thing that I do, that we do at EarningsBeats to give back to the community. So it is free. There will be trading candidates on there. Of course, the risk of trades is completely up to you. I can't tell everyone what their risk tolerance level is. You have to figure that out on your own and decide whether or not it's worthwhile to make a trade. But I will give a lot of trading candidates. I'll talk about, I'll do a lot of education, candlesticks, gaps, volume, price volume, trend lines, moving averages. I mean, all the basic things that you hear most technical analysts talk about. I also talk a lot about relative strength, which to me, if you're going to trade stocks that are strong performers for the most part. I think you're going to see your results go up a lot if you stick with stocks that are strong and avoid these one-hit wonders. Stock comes out with good earnings, but you look at a long-term chart and it's been downtrending for the last 15 years. Why is this time going to be any different? Stay away from stocks that just can't get their footing from a long-term perspective. Stick with the winners, the long-term winners. There's a reason why people who invested in Apple and Amazon and Google and all these companies, Netflix, NVIDIA, years ago, they're set financially because they get in with these solid companies that have a track record, and those are the stocks either they just hold or that they trade. You get Apple on a pullback, there's not too many other companies I feel really strongly about they're going to go back to an all-time high. So when you get the pullback like we had recently, Apple tends to be a great buy, either for the long term or for a trade. Anyway, chart of the day I wanted to go over today is FRPT. This is Freshpet. And I actually own the stock, so full disclosure there. I loved the gap up yesterday on the buyback, and this is a strategy that I've employed for a long time. I like to buy stocks, and I'm talking about very, very quick trades. I did hold this one overnight. I could have taken a profit yesterday at the close, but I really like the earnings report that came out here. I like the fact this stock gapped up above resistance, and when it pulled back yesterday, I jumped in. First thing I was looking for was back into the 116s to test this area. Of course, 110 is possible, so I left a little bit of powder dry in case we got down closer to 110 to fill that gap. I don't know if it'll go down to fill the gap or not. We came right back up, and the interesting part on this chart was if you look at the 10-minute 5-day chart, you can see there was the gap up. We went up over 127 intraday. And then literally 15 minutes later, we were back below 118. And that breakout level on the daily chart is, I think, around 116.25 or 116.50. And our low yesterday was 116.50. So that might be all we get. And then look at what happened in the afternoon. The buyers started coming back in. Volume started increasing again. And so I think the stock could be poised to go higher here. But again, I'm keeping a little bit of powder dry in case we go a little bit lower. But this is a chart that I thought looked really good. Again, when we look at a stock's relative strength, look at how the stock is performing relative to the food products index. So it is a little bit more, I'm not going to say it's safe because we just had a huge gap up. I mean, this could easily go back down to 110, but it is in a safer area of the market, more defensive oriented food, think consumer staples. But there are opportunities. I mean, this is a stock that's gone up from 55 to 120 in the last 6 or 7 months. So I wouldn't exactly say that this is a conservative staple stock that doesn't move much. I mean, I think you got to admit that this is going to be a little bit more volatile than your standard consumer staples trades. But still, it is in that group. And, we'll see where it goes from here. But I like the chart. They did come out. Let me see if I can find real quick for you. I haven't added it there. Let me see if I can just come up with their earnings and revenues. Let's see, earnings. All right, so their earnings, they were expected to lose 22 cents a share, and they turned a profit of 21 cents a share. That is a 43-cent earnings beat, going from a 22-cent loss expected to a 21-cent gain profit. Pretty big deal there. And then on the sales side, believe they also beat here, but let me just double check this. Yes. So they were expected to come in 216.4 million in revenue. They came in at 223.9. So nice beat there, probably 3 or 4% beat on the revenues, and then a huge beat on earnings. Big gap up, a little bit of early morning selling, which you got to be careful chasing at opening bell on these gaps, because when everybody wants to buy, market makers are on the other side. If you look at these previous gaps, look at where we opened and look at how far we went down. Probably went down $5 intraday before we rallied back. Here, we opened, we got up to about $73 or so, and then ended up moving back down to 67. So it was about a $6 reversal. and finishing very similar to that candle right there, as you can see. So in this case, we never did fill the gap. We went back down kind of near the low of the day from earnings and then turned right back to the upside. Here, we really never went down below this low. You can see over here, all we did is went back down and tested. So last two times we have not filled gap. Maybe we will this time. But anyway, that's the reason why I like the stock. I mean, I think between the solid earnings that came out, the reaction to the earnings, the way the stock has traded in the past, I think all of those reasons are reasons why, in my opinion, 116 or a little above, and then maybe 110, those two areas are key support levels for the stock and areas where I would be interested in buying. But again, what it did here was, well, again, I'm going to talk about what it did here at 4:30 today. So we only have about 5 more minutes, and I want to go into momentum sleepers. I want to show everyone, now that the market seems to be coming back, where were the leaders? And I was actually in the middle of this when the show began. So let me finish putting this together. So what I've done is I went back. All right. So let me just show you what I did. I went back and first typed in IWF/IWD. This was growth value, because growth from May to August, it's best 4 months of the year relative to value, growth versus value. Growth does its best from May to August. We're just starting May. So if growth is going to return, I want to know what are some of the stocks maybe that I should look for returning. Well, growth versus value, this is the IWF/IWD. If you look at it, you can see it topped all the way back in the second week of February. And since then, we've been mostly declining, moving lower. So I thought, well, I'm going to go back into some of the key growth industry groups, and I want to pull all the stocks that had scooter ranks above 95 back on this day when growth was in favor. And that's going to give me a pretty good list of stocks that were leading just, a couple of months ago that potentially could be ready to resume leadership if growth, again, like it has in history, follows that historical path and growth outperforms value for the next few months. So that was the whole concept behind putting together this scan right here, which is where I'm saying 59 days ago, scooter was greater than 95, and it's in one of these groups. And, I want to find one of these groups. If I left and in all these groups, it would return 0, because you can't be in the internet group and in the broadline retail group and in the semiconductor group. You're in one of these groups. So when I put this together, you have to put these 2 brackets at the beginning, these 2 brackets at the end, and then in between it's or. So it can be in any of these groups. So I'm basically looking back 59 days ago, which is almost 3 months. And I'm looking in these groups. Not going to run it against the whole market, but these are some of the groups that I feel like have high octane when it comes to growth. Internet, broadline retail, specialty finance, heavy construction, computer hardware, semiconductor software. There could be others. There's probably another handful I could have thrown in here, including autos, electrical components. I could have even thrown in something like biotech or medical equipment, areas that show a little bit more aggressive tendencies. But anyway, I went with this. Haven't even run this scan, so I have no idea what's going to come up. And then I run the scan, and I've got 57 companies. So these are 57 companies. And what you could do is you can see which ones are still above 95. So these are companies that have continued to hold on to some of that momentum. You look at Supermicro, CleanSpark, MicroStrategy, Coinbase, Klupin. I don't even know this stock. Volume 619. Stay away. Make sure they have adequate volume. I didn't put a volume filter into the scan. NVIDIA, Williams-Sonoma, Dell, Porch, Spotify, NTN. On to CrowdStrike. Going down the list, Monolithic Power, GoDaddy, Palantir, just reported, by the way, PLTR. And it is now 9:29, market getting ready to open. But that is basically what I have. Let's see where Palantir was about to open. It was down $2 before, down $3 this morning. I'm watching down here around 20 and a half. I think if it were to get down to there, it'd probably be worth a shot. It's an aggressive stock, so only apply if you have a high risk tolerance. This thing could be anywhere. It could be back down at 17 later today. It could be back up at 27. I couldn't tell you where it's going to be, but this is the trading range: 20, maybe just above 20, up to about 27, and anywhere in this range goes. So the closer you get to the bottom of the range, the better your reward to risk is if you're trading the range. But with a gap down, maybe in the morning, we do get a little bit of weakness. Dip wouldn't take much now to get us into the 20s. And that would be a kind of an interesting area to maybe take a shot at Palantir. They did report yesterday. So let me see on earnings surprise if they're on here. I am not showing them beating yesterday. Did they miss? That's the next question. No, I'm not showing that they missed either. So I'm not showing numbers on Palantir from yesterday. But anyway, market reaction is down, but stock's been going up. So let's see if it holds on to that 21 level. Or excuse me, 20 level. But that's it. Let's get a quick look at the market because it did just open. We got the Dow up 22, S&P up 8, Nasdaq up 10. Small caps showing just a little bit of leadership, up 0.25%. Look at the VIX back down 1347. Folks, bear markets don't exist with a VIX at 13. They just don't. Go back and study history. If you think we're in the middle of a bear market, when a bear market starts a decline, I'm not talking about the entire secular bear market, like from 2000 to 2009. What I'm talking about is when those declines, those big declines start. And if that's what you think we just had in April, when the VIX went through 17 to the upside, history tells us that if it truly is a bear market decline, you don't see the VIX go back below 17. Definitely not below 16. I think intraday below 17 maybe, but not 16. We're back down at 13. Fear has come all the way back out of the market. This is not what breeds a bear market. We're going to talk about more of this about this at 4:30. You don't want to miss this event coming up. So go back over to EarningsBeats. Make sure that you sign up. Click on this Don't Go Away in May Mythbusters event. Check out information and make sure you get registered. Also, please like our video and subscribe to our channel. It would certainly help us as we try to build our channel and build all the awareness about EarningsBeats, the way we approach the market and so forth. Even if you're not a member, that would really help us and go a long way, and we'd certainly appreciate that. Have a great day, everybody. Happy trading.